Good afternoon, and thank you for joining this Yellowstone Advisory webinar. Today's company presenting is Capita, and we're delighted to have with us Adolfo Hernandez, the CEO, and Pablo Andres, the CFO. We'll give an update on performance following the publication of the FY24 results, which were released on the 5th of March. I'd now like to hand over to Adolfo Hernandez to start today's presentation.
Okay, good afternoon, everyone. Thanks, Alex. Delighted to be here. This is, I think, the second or the third time we get to do this. It's always a great opportunity to share, not only with the institutions and the large shareholders, which we do and we've been doing extensively for the last couple of weeks, but also with this very important shareholder base that is our retail shareholder base. I joined the company just over a year ago. I think last year about this time I was presenting somebody else's results, sort of in my 6 weeks in the business. I had to preside by a very lukewarm reception to the results. But, I was still excited about what we could do with Capita. My core belief prior to joining Capita, and based on my first few weeks of investigation at the time, led me to believe that it was a really strong company with regards to customer relationships, tenure in terms of customer contracts, and a really deep understanding of some very complex business processes, and that I had a really good employee base that was expert in delivering to the customer satisfaction. It was also very clear and very apparent that I think the company hadn't been able to address some very fundamental questions around the strategy. It was clear that obviously we were spending the same amount of money that we were generating in revenue, hence generating losses and burning through cash. And there were a number of big to-dos. But at the core, I believed a year ago that the mandate was one of how do we sustain and amplify the good things that this company does, but at the same time generate a decent financial return for it, right? And that was the journey. 12 months on, I think it's just been very, very busy. 2024 has been a year of what I like to define as sort of deep root and branch transformation of the company. We are touching absolutely everything because I think everything is subject to improvement, because the world has moved on, because the market is presenting new opportunities, and we have to go and revisit pretty much everything that we're going to do. On the next slide, you'll see there the fundamental 4 areas that we decided to bucketize our strategy when we presented at Capital Markets Day. We said Capita was already a good company, but we needed to build a better company, right? And largely it was one that needed to work on 4 vectors: the technology vector in everything that we did and how we did it and how we offer it to our customers; in the efficiencies, because we were too big, too complex, too heavy, and it was just creating problems, not only in our financials, but also in our bid competitiveness; in our delivery, because even though we were doing well 95% of our projects, the 5 or 10% that we were not doing well were costing us dearly, and that was something that it was a priority; and a better company for our colleagues and our employees. It was always going to be a tough journey to go from where we were to this sort of better company, but we needed to build a better company with and for our colleagues. And as a result of that, we will get that improved financial performance. We're going to get some clarity as to what we stand for and what we're trying to do. And we will have a much better value proposition both for our colleagues and our customers. So that was the Capital Market Day strategy, and we stated some financial ambitions that have not changed. So if I go forward now into the next slide, you can see there, I'm going to just go and give you an overview of each of the 4 pillars. It's a little bit of a flyover, but we can always address some specifics in the Q&A. Technology is one of the areas where we've been super busy, super busy, because we had a lot to do, right? We have always tried to be a very tech-enabled BPO. I'm trying to be more of a more on the BPS than the traditional outsourcer. But we needed to be able to ensure that the technologies that we were bringing to market were actually something that was truly outcome-based, and surely we were not trying to recreate something that the hyperscalers, the very leading companies in the planet, the Microsoft, the Salesforce, the Amazon Web Services, the ServiceNow, Palantirs, and others are already creating, right? We needed to come up with something that was, okay, how do we extend what they are already doing and build that Capita layer? How do we package that customer expertise that we have and build it on top of their solution rather than trying to recreate something that is there? So we needed to walk away from the very formal, very waterfall, traditional tech culture of Capita, of everything has to be done here and very long development cycles, very capital intensive. That has not really worked well over a decade, to something a bit more agile, with more empowered teams, smaller teams sitting in front of the customers, working in what I call cloud timing, so much faster cadence of innovation, and leveraging security and governance that is already built in these platforms right from day one. So we started doing a lot of that work. Initially, it was me leading the charge with our head of strategy and transformation, Senia. Obviously, late last year, we had my former colleague at Amazon, Samir Vuyuru, joining us at just Chief AI and Product Officer, and he's now leading the charge in there. So as you can see on the next slide, we've actually achieved quite a lot, from going and overhauling a myriad of bespoke call center solutions to totally rotate onto the Amazon Connect platform, or launching, as we did 2 weeks ago, the AI Catalyst Labs, where we're actually now offering customers the discovery, modeling, piloting, and acceleration of AI processes, or being one of the first companies in Europe launching Agent Suite based on Gen AI on top of Amazon's Bedrock. We've established a significant pull out of nothing of Microsoft Copilot expertise internally. Actually, we created some sort of like a tech venture inside with different groups, no matter where they are, who know our process really well. If they feel they can get efficiency or improve the service, they come and they pitch in for what they want to do and the business case and what they committed to do, and then they'll get access to licenses. Or what we've launched just a couple of months ago with Salesforce, to be one of the first companies in Europe launching Agentforce and Agentforce-based solutions. So agentic AI, in our case, an agent capability launched, created specifically for the needs of high-volume recruiters. Those companies that have to recruit a lot, that have to sift through maybe 50 to 100,000 CVs a year, as we do, and many other companies do, and then really move the recruiters to where the recruiters add value and let the AI piece to engage up front. So this is just to highlight a few, and as you can see from some of the quotes there from Zara, I think we've really upped the level of collaboration there. The proof is in the pudding, right? So where is it working already? So if I look at the contact center, yes, we got over 200 people, colleagues who are in the support functions that are now enabled by AI, but probably most interestingly, we are going to have by the second half of this year 5,000 agents that are going to be augmented by AI. That means that the agent is doing the normal job that they normally do, engaging with customers, but running in parallel to the workbench. They have an AI agent, and that's the Agent Suite, built on Bedrock and launched in July. That is actually going to be helping them with the understanding the calls and transcribing the calls, helping them predicting what the call is all about, predicting and suggesting what is the best way forward based on the machine understanding of what's happening. It will summarize the call, it will take care of administration, and effectively it's just going to make the agent so much more effective. It's already reducing average handling time by 15 to 20%, significantly reducing the admin overhead in between calls. That is not only costing us and our customers money, but it's also costing agents a lot of job satisfaction. So that reducing that admin bit is really, really good. And as I said, this is something that's going to be deployed. In public service, we talked about the work that we do on medical records processing, shortening the processing time. We've talked about some of the great virtual reality work that we're doing for the Navy in the Navy training. Maybe less known is some of the work that we do in local public service with Appian in terms of building a totally automated workflow targeting the very real pressing issue of local authorities to collect age debt. So, and it's an outcome-based service offering by ourselves. And then similar in our good pensions business, and the whole step that we've taken towards digitization of the platform, and how do we use our existing backbone of HardLink, which is proven to be a rock for our business, but it's a legacy rock, and how do we complement it with Microsoft's front end to give us the Microsoft mobility, Gen AI, Open AI capabilities already, so that we can offer a much better, more personable, more efficient service to both trustees and members of those pension plans. So very excited about seeing all of this at work. Many of these things in production already ramping up. There's many others that we talked about, the work that we're doing with the Silvertown Tunnel for DFL, with registration. How do we go from multiple days to register if you're a local resident to seconds? How we've been able to reduce from nearly 400 agents required to do that to just over 130 agents. And obviously we are being paid on the savings and on the cost avoidance. And actually, by just sharing that cost avoidance with the customer, we might be getting less revenue, but we're getting a lot more margin, which is, I think, is the name of the game. So it is working. It is early days, but we have really dialed up technology, because the world that we move in is going to be one where business process services are going to be relying more and more on AI, more and more on better data, more and more on automation. And the type of opportunities where we work, we believe, have a sweet spot for companies that obviously you have to have the trust of the customer, you have to be known, you have to be trusted, you have to be experienced with them. Through that, you have built expertise around the business process, which is super critical. You have also built a team that's going to work there, but then ultimately you've got to be able to add the technology. So for us, this concept of hyper-tech, but with a human in the loop, is a key differentiator and something that is working well. So that was a quick flyover on tech. On efficiencies, let me just say that a year ago, I upped our objective from 60 million to 160 million by the end of June 25. We've reported we've done 140 by the end of December. So we are ahead in quantum and ahead in time. Because we can and because we should, right? Obviously, we need to create the space and make that capability so that we can save, be more competitive, but also reinvest a little bit so that we can fix the basics in the business, but also build the future. Because the future for business process services that are heavily tech oriented with humans in the loop is a great future, and we just need to make sure that Capita, from a strategic perspective and from a capabilities perspective, is there to stay. So better efficiencies is an absolute enabler, so much so that as we have been doing this and we've been picking up different bits and looking under different carpets, given that there is no sacred cows, we've decided that we're going to go further than that. So we've decided that we're going to go and add another 90 million to get to 250. Because that sort of is forcing us to really question absolutely everything. And this company's been around for a long time. It's been doing things in a given way for a long time. So questioning and re-questioning is a good thing, is a good habit. Scarcity always creates innovation. That was one of the predicaments that my former employer, Amazon, was built on. You have to be very frugal. If you're very frugal and you really look and you really think, it will force that sort of a step change in innovation. I'm trying to bring some of that focus here. So very happy with the progress and efficiencies. There's more to do because there's more to enable. And then as we move on to the delivery, eventually, there we go. One of the most important achievements from my perspective this year is that in spite all the work and efficiencies, customer satisfaction has gone up, right? Normally, the way it works, you really cut down to the bone and then you rebuild. and then clients get caught in that exercise. We've managed through a lot of focus and emphasis on this is what we're doing and this is how we're going to show the customer, but also this is what we're going to show customers because they're going to be quite excited to get to that position where customer net promoter score has nearly doubled, and we've done a lot of things. So got a couple of examples here which I just wanted to sort of share. One is in the public sector, the other one is in the contact center space. And the public sector, a deal that we were unsuccessful for a variety of reasons. It was with the sort of old Capita. It was retendered, and we introduced more tech, more optimizations, both in the back office and in the front office, working with hyperscalers, put a more competitive bid, and on the retender, we were successful. Client B, a contact center that was, it was just unsatisfactory for us. We were not working well. It was a model that was an old delivery model. The financials were not sustainable. We terminated the contract. The customer went out to market. We bid in the new process with the new approach, the new value proposition, and we won. And now we're now delivering the same contract in a different way with different tools in the bag, but now it's a profitable contract and one we have been quite happy to regain, right? Not retain because we actually parted ways, but we will come back. So the point here, these two is just examples, very early days, that what we're doing, it's finding itself. It's a path with customers has been really well received. Unfortunately, you also saw in the release, we had some unsatisfactory historical projects that turned into headwind in 2024. So this is 2023 projects that we didn't do what we should have done in 23, and as a result, they became a problem in 24. And now we're dealing with them, and they have costed us in excess of £20 million in this year. So if you look at that amount in the concept, in the context of the profit we make, it's important. So the topic of delivery, making a lot of progress, but there is still more work to do as we go into 25. And then last but not least, on people, this has been the hell of a journey for our colleagues. Very difficult year. New CEO, new strategy. Halfway through the year, Pablo arrives. New CFO, new head of strategy. There's a number of people who've just been appointed new. So a lot of change in the top. But at the same time, we announced a lot of cost cutting. We've been moving, transforming, reorganizing, automating. So I think it would be fair to say that initially, first part of the year, I also had to make some very unpopular decisions with the executive team of no bonuses, no salary increases. Literally, we're just going to get on with the work that needs to be done. So probably at the beginning of the year, sort of a decline in engagement that's actually come up now and is broadly in line where engagement was the year before. Okay, that's a baseline. I wanted to bring it even farther, but considering everything else that has happened is fine. There's a number of areas to go and pay attention to. Obviously, the employee net promoter score is lower. If you think about it, employee net promoter score is the one question, which is, would you recommend Capita as a place to work to your friends and family? Well, if you've seen the amount of changes, job reductions, cost cutting that we've been doing, you might still like it for yourself, but you might not recommend it to others. And I don't expect that to dramatically improve until we're really through and we become that sort of better company, a company that it's just not in the situation where we're still at. But we're paying a lot of attention to that. On the other side, there's a lot of things that are really, really important, right? Inclusion index, people feeling they can be themselves. It's a very diverse company. I think we've got a really healthy balance in terms of diversity and equality and inclusion. We're doing a lot of, at a time when there's been a lot of woke and there's been a lot of massive counter reactions. I think we've got the right spot where it just feels like it's a nice place to work, admittedly with a lot of change going on and still a little bit of risk. Attrition continues to go down, so that's definitely a good sign. And internal mobility is going up as we are sort of delayering and removing overheads, we find that there are people in the organization that were sort of hidden or buried, but they were talented, and we give them the opportunity to go up and play a bigger role and responsibility. So I know this was a very busy flyover, and I think in the next slide you sort of see the key themes there. Pablo will give you the numerical color behind it, but it's been extremely busy. I feel now that we take the industry going more toward technology. If I look at our largest and most important segment, which is the public sector in the UK, from the Prime Minister down, now really rotating onto more AI and transformation and change and reduction, which speaks of needing industry to do that. If I look at the key themes of the UK AI roadmap, the action plan, so it's the things that really play to our importance. So a lot of work done. We started to sort of make a dent, and I think there's some early green shoots in multiple areas. And then the other thing that we wanted to do, which is start sort of work on the financials. I mean, I picked up very loud and clear from this community, but also from the large institutions, that we needed better unpacked reporting, more transparency into some of the work. So Pablo's been quite busy at this, getting segmentals sorted out and doing a number of housekeeping initiatives that he's going to quickly present, and then I'll be back for Q&A.
Brilliant. And good afternoon to everyone. So happy to be here with you. I'm going to canter through the financials. They were very clear, well explained, and important, and we'll leave more time for Q&A. On the financial highlights, spoke about it, revenue reduction 8%. It is in line with our expectation. We had contracts lost from prior years, but actually our focus is to make the company smaller, to become fitter, stronger, to then grow with a good cost base that makes us a lot more competitive. That 8% has got different things in it. In public, we started with the losses from the EMS and so on, but then in the second half, we started to slightly grow. In contact centers, we're still seeing impact of prior years, but also some volume declines. Pensions really good, and then closed book life and pensions went back 50 million, and that is good because we want to exit that business better. The second point I want to focus on this slide is in the margin. I think it was good progression, but that is not making justice to what we did. You see that we had 34 million of one-offs, accounting, deferred income, releases, or settlements from the prior year. That means that actually, if you take those one-offs, the prior year would have been really 2.2% gross margin. And the 2.2 to 4% gross margin is 180 basis points. That was mostly achieved through cost reductions. We were a business that spent 2.5 billion in delivering 2.5 billion revenue. It was obvious it was not sustainable. Others can make money out of it, as we highlighted in the Capital Markets Day, and that's what we're on to. Then finally, the last element I would touch on this slide is the net financial debt. Through the disposal of Fera and Capita 1, we've ended up in 0.5 times EBITDA. That is a much healthier position to be from where we've been to. So going quickly through the rest of the slides, on the next slide, we have public service. As I said, revenue starting to recover in the second half of the year. Slow progress, but it's still a healthy business. You see in the bridge below the impact of the contract loss in the prior year. We also had a big hit from Smart DCC business, where there was contract work in 2023 not repeated, but actually the Ofgem gave us a pretty tough 2023-2024 price determination. Since then, learned the lesson, put in place the processes in place so that we will not move an inch unless it has been in writing with our customer, even if it's not that agile, but we cannot run the risk of the regulator coming later and overseeing all of the commercial agreements we had in place with our customer. In any case, cost savings, delivering significant improvement coming through, and at the end of the year, we've improved 20 million, 28% our operating profit, with a decent cash conversion that was slightly affected by the delayed mobilizations. On customer contact center, again, contact center, huge progress, but a little bit hidden by the one-offs we had last year. VMO2 contract, historical contract, was terminated to enter into a framework agreement going forward, and that triggered the release of 18 million of deferred income into the P&L. Well, if we look then, the real losses from the previous year were 22 million or recurrent. We then have had volumes in the telecoms vertical of 24 million, which has been more than offset by the cost savings, and net, you could say there has been an improvement on real trading from 22 million losses to 6 million losses. A lot of work to do to get to where the margins that this sector are, and through further savings, we're expecting to get this business back into the black during 2025 and continue progressing. Pensions, I'm not going to touch much more, but just to say, I think one of the things that Adolfo and I have been picking up is that actually the market did not really understand that we had this beautiful business with very decent margins and very strong cash conversion. The market did not understand that actually within it, 30% of the revenue is a consultancy business on pensions, more than 500 people, again, delivering a very attractive business. We've got a strong position in the market, and it's a business that is doing really well and continuing. And the last but not least is the business we want to exit. This business was comprised of evergreen contracts that were relying on a technical solution that was never delivered. And the only thing we had here is liabilities to walk away from as quickly as possible. Huge success over the last couple of years. We started with 8 customers. Today, we're back to the last customer with whom we are negotiating the exit. The exit out of this segment takes a couple of years or 3 to hand over the processes and the services. But the good news is that for all of the rest of the customers but one, they have been agreed. They are provided for in the provisions note. We're only working with the last one. We have said, though, that the last is but not least. This segment would continue delivering 20 million losses on an ongoing basis. And that is why it is one of our top priorities for this year, which is to resolve and agree an exit path to this last and final customer. The good news is that having decided to exit, I think the customer understands the importance of exiting this segment. The regulator is looking at this because we've highlighted we want to go out and we don't want to have problems with our members. So I think the groundwork has been laid for constructive conversations that have been ongoing for quite a while now, and we expect to make progress during this year. So cash flow, everybody knows that this business has not been having great cash conversions because of history, legacy, deferred income flowing through the P&L. It used to be at the range of 100 million. It went down to 80. We're now down to 50 million as that deferred income book in the past with the matching CFA being written off flows through. We expect that to be around 50 million for the next couple of years and then continuing declining. And in working capital, when I came in, I looked at it and I thought it was better to take a more balanced approach to it, which is why you're seeing the 54 million there. I expect that number to be smaller during this year as we have stabilized the situation. Further, that delivered a cash conversion of around 40%. If you look below there, we had the final and last payments on pension deficit. The cyber incident that we said 25, here you've got 20 plus 5, 25, and the investment on cost reduction program of 45 million that we underspent by 5, but I'm planning to spend those 5 in 2025. Next page, you get to see the final picture. We pay our CapEx, our interest. We make progress in reducing our lease payments by 10% every year as we've earmarked, and that has left us with a closing net debt. One of the things that was not well understood either was how our net debt and leases work. Net debt is a standard term out there. It is debt with financial institutions and leases. Yeah, that is therefore 66 million of financial debt that I spoke at the beginning and 300 million and 50 million of IFRS 16 lease. However, this company, through the restructuring and rationalization of our property estate, entered into a number of onerous leases that have been disclosed in the P&L and that were there. To me, when properties that are not being used are being sublet. I'd rather pass on the head lease, but in the absence of that, second best, sublease it so that at least we get the money covered. And that is where we have 96 million of sublet lease receivable recorded as financial asset in our balance sheet. You cannot count it into the closing net debt, but to me, the number I'm looking myself is 349 million minus 96, around 250 million on net lease liabilities that we're having to pay for based on what we've got contracted today. I think that is something that we are asking everyone around to focus on, because otherwise we're not seeing the full picture. And we continue making progress. That net number reduced by 14% during the year, and we will continue working on it. Finally, moving to the outlook, I think there are a couple of things here. Part is the outlook and part is the housekeeping. In terms of outlook, public service low to mid single digit growth this year, particularly second half weighted. Contact center, as we see the volume reduction on the telecoms vertical, we will see a high single digit revenue reduction. Pension solutions business will continue ticking along very nicely. And unregulated, we expect the revenue to decline as we hand over the contracts, which is good. Operating margin, therefore, will only improve marginally. And the biggest item here is that we will deliver the savings, but the regulated business will have profits more aligned to cash flow as the water is coming down, exiting most contracts, and we have less noise there, which is more a reflection of reality. And that is what will drag the margin progression. What excites me most about the outlook is the free cash flow projection, because our guidance is 45 to 65 million outflows, but they include 55 million of restructuring costs within them. So one can argue that actually our outflows for this year are mostly the restructuring costs, but one can also argue that as we finish investing those 55 million on restructuring costs, that will leave us on a net positive cash generating platform going forward. I've been asked, Pablo, when? I don't know if it's going to be September, October, November, Christmas Day. But at some point when we finish spending our restructuring money, we are leaving the foundations for positive free cash flows from the end of the year. And then we go into the housekeeping section. Housekeeping, we've issued 94 million of debt. Basically, we had 74 million of maturities between April and between January and April this year. And when I look at what was left after these maturities, it was 190 million of debt with 120 maturing in 2026, which understandable, but it's not a very reasonable maturity profile. So I saw the opportunity in the market to issue debt for between 3 and 5 years at much tighter spreads than the previous issuance and at a lower cost than that of our RCF currently. And we've taken the opportunity just to tidy up our maturity profile going forward. And then probably the other items of housekeeping that we've done is share premium cancellation. So when you look at the parent company, we thought that converting the share premium into distributable reserves is the right way to go about it. And we will propose the AGM to vote on this. But that basically leaves Capita in a much stronger position with more flexibility for the future. And the other one is the share consolidation of existing shares, which sounds sophisticated and smart, but it's actually pretty simple to me, which is that instead, there is a perception in the market where having a company valued in pennies is less attractive. So I looked and said, okay, show me the facts. The facts were that out of the FTSE All Share of 545 companies, we're in the smallest 10 price in the pennies of them all. And yes, that can be a deterrent for institutional UK, but also international investors to look at this company. And then when you look at the total shares in issuance, we are in the very top 10 percentile of them, with all of the big ones there with Barclays, Kingfisher, etc., etc. It's not balanced. And I believe that for the strategic period we're looking at for the next 3 years, when I look at this, I think that by doing the share consolidation, that basically what we're trying to say is, instead of valuing Capita at 100 in 25 pound notes, just value it on 20 pound notes, and it's only 5 20 pound notes. That's basically what we're doing. And I think that by doing that, we will make it more attractive for new potential institutional investors. That is really it, removing the stigma of the penny stock and moving it forward. Actually, it was interesting that when I joined, some of the new investors that we have in Capita that are well known by everybody around were actually recommended that we consider this. And we've been hearing around and thought that it's the most sensible thing we can do for everyone else. So this was the last and third item of housekeeping that we've been doing. And I think that's it for me. Well,
in terms of 2025, thank you, Pablo. I think it's, as you rightly say, there's an element of housekeeping on the segment reporting and bringing clarity of what we're doing where and showing what the numbers are. And then, I think the question is what we're going to do in 25. The beauty about 2025 for me and for the rest of the executive team is that it's more of 2024. Right, we're rolling in, and the focus continues to be around the cost transformation, those efficiencies, moving now more into sales effectiveness. We've generated this year a very good pipeline, right, of excess of 11 billion pounds, of which 5 of them have a technology or a hyperscaler underpin, which is exactly the space we want to go there. Deliver the innovation and the capabilities around tech so that we can win more of those at a lower cost point, and win more often the ones that we want to win. Keep tuning the operating model so we can become more agile, still not agile enough, still the parts of Capita that are moving at a slower, more bureaucratic speed. So we need to change that. And as we keep changing and driving engagement on the new culture, and we'll focus on winning, and we get better financial results, this has to sort of be more of a high-performance organization. So all of that, bring it together. If you could have some of the things we've already achieved, you see on the left, and what we're doing in 25, and the fact that we're running, we don't have set up time as we had to have in 24, as we were learning about the business and building the team and having all that period of really pushing that oil tanker to move. We remain with the first sort of stage ambition under the medium term of operating margin of 6 to 8%, the free cash flow conversion 65 to 75%, and then towards the end of the period, as we finalize the phase of getting smaller to get stronger, to get fitter, to then grow, getting the low mid-single digit revenue growth going on. And I think as we weed out some of these old businesses that are costing us profit and cash, that will give us a better baseline. So very excited about 25. I know it's going to be as horrendously busy as 2024, but this company's worth it. This company's worth the effort. We do great things every day. A year and 2 months in, I am in awe about the impact we have in people, in society, in departments. I was yesterday the Minister for Schools and everything that we're doing for standard testing for kids, what we're doing enabling vulnerable citizens, what we're doing in the defense space. This is a great company. It's worth making it a better company and getting us all a better return. So thank you for your support, and I guess we'll open now to Q&A.
Thank you, Pablo. Thank you, Adolfo, for that presentation and for answering those questions. Not answering those questions. And we're now going to open up for questions. And just as a reminder, if you want to ask a question, please type it into the Q&A box at the bottom of your screen. So let me start off with something that's come in ahead of time. And the first question is, can you explain to a layman what exactly are the hyperscalers? What are you doing with them, and what impact you hope it will have on your business?
Yeah, excellent question, and it's good to be reminded to sort of explain it in layman's terms. I guess having worked for one of them, you sort of go deep in. So hyperscaler is the sort of the collective name that is given to the traditional tech companies that have developed so quickly. They've been sustaining 20, 30, 40% a year-on-year growth in revenues, and they have built a disproportionately high scale and presence in the tech world. So much so that the tech capabilities now, as we look into sort of the mid-2020s, are way more concentrated than they have been at any point in time in history, bar the 1950s and 60s when everything was with IBM, right? It was a period where everything was very fragmented. There was a lot of tech companies, everybody was playing there. Now you've got Amazon Web Services, right, which is north of 100 billion of annualized. You've got Microsoft with all the tune they've done into the Azure world. You've got some of the unicorns of a decade ago that are now major companies like Salesforce or ServiceNow and others. And why they are so important is because combined, you might be reading, how many billions, each of them, like tens of hundreds of billions, are going to be investing in data centers, in power, in AI, in models, in training models, in open AI, in the cloud new technologies, what they're building in terms of local zones and regional zones in terms of the cloud architectures. And it's very important because they're bringing a capacity that can only be had by these hyper guys that have hyper budgets. But they also bring an ability of innovation and amount of discrete services and capabilities. They bring it at a speed that medium-sized companies cannot match. And why they're so important for us is because they provide many of the layers that we used to have to deal with in the past. So in the old days, going maybe a decade ago, maybe 5 years ago, a company like us would have to secure a data center. We have to secure the networking of the data center. We have to secure the security. We have to go and get the operating systems, the instances, the applications, the databases, then write the business logic, and then sell the service. But by the time we got to do the service, we had already wasted and invested way too many months and quarters and years and a lot of millions in capital and in people. Today, we don't have to do that. To get to the service layer, we can just go right and write that wave of innovation and write our capabilities on what's called microservices and APIs. So all we do in Capita is map our understanding of the business process to those microservices. So it's like having an endless R&D department that gives you something that is 80% of what you need, and you don't have to worry about it, and you don't have to build data centers, you don't have to update it, you don't have to write it off, you don't have to worry about security, you don't have to worry about governance and all of these expenses, and just focus your energy on the 20%. And that was, for me, having been in one of them and having been part of the drive, it was very, very clear when I came here. As I said, there's no point. Let's just focus on where we're going to have our differentiated value. And for them, it's a blessing because they don't understand about the business process. They don't understand about customer registrations for services. They don't understand about how do you provision a parking permit. They don't understand about how do you do to get a disabled student through high school. Right? That's not their understanding. That's what we understand. So we give them the last mile, and they give us the previous infrastructure. So we've been really lucky with the timing and the maturity of our industry. The other way to look at it is one of the main reasons why I decided that I wanted to take this role, and I was confident I could turn it around, is because I was super confident that the hyperscalers could solve for me the most cost and time consuming part of it, which was building all of that enabling infrastructure, and I knew it was there. So that de-risked the transformation from my perspective a lot. Okay. So hopefully that was clear.
Yeah, no, very clear, thank you. Another quick question we've got here on the technology side of things. Integrating AI-driven automation sounds great, but what does it actually mean?
Yeah, it means to look at processes and tools to complement and enhance what humans do, So the process happens faster, with less errors, and at a lower cost. So I mentioned earlier the case of the Blackwall tunnel, right, and a number of tunnels that we the other one is opening on April 9th. So the traditional registration process for local residents to get the discounts would be something that you would need, as I said earlier, close to 400 people to do it. When you inject AI in the process and you start doing character recognition, when you start doing component extraction of what's in the document, when you start doing fraud analysis, looking at the layers, looking at which images might have been tampered with, which documents might have been doctored with so that you can qualify for the discount. You could have humans doing that and taking 5, 6, 7 days in doing that, or you inject tech, and then effectively what tech can do will be done by tech, and then the humans in the loop will do what humans do, right? Which is looking at the case and finally approving it with supplier, or dealing with escalations, or dealing with discrepancies, right? This is just an example where you get AI automation into a business process and you get an acceleration, a cost efficiency that it's good for our client and it's good for us, because we will also be saving money and we will have a happy customer.
Okay, thank you. Got a couple of finance questions here. What does your operating cash flow conversion of 65 to 75% assume happen for the regulated services business?
Yeah, thank you for that one. The guidance that was given back at the Capital Markets Day, which is the 65 to 75%, does not assume any resolution of closed book life and pensions. It assumes it is within the group as it is today.
Okay, thank you. And then again, the finance question is, just to be clear, are you expecting to make any further pension deficit payments?
Not for the foreseeable future. The last triennial valuation, the pension scheme was fully funded. The last contributions were made in H1 2024. And actually, the pensions contribution, when we've looked at the numbers at the end of the year on the same basis, it continues fully funded in a very healthy way. So no, for the foreseeable future.
Okay, thank you. A couple of questions here on the sort of contract value and the pipeline. So Capita's total contract value won in 2024 was significantly lower than in 23. Whilst this was attributed to reduced bidding activity, what is being done to improve Capita's win rate and competitiveness in securing new contracts, and what specific changes have been made to the sales and bidding process?
It's an excellent question. I've been the best part of 20 years in enterprise sales and government sales. And if there's one thing that I learned, is that it's a question of quality, not a question of quantity. And in many organizations, it's quite common that you build these pipelines and then you engage in a lot of different bids, way too many bids that cost you time, cost you money. And in aggregate, you spread too thinly and you don't win enough. And then you might not even win the right ones, and then you might under-resource the right ones, right? So one of my observations being here, and it's actually something that the two CEOs of their respective businesses, Richard and Corinne, as they took over, observed, is there was a lot of people chasing a lot of things, right? So as a result of that, obviously we incur higher costs and we didn't win enough. If you look at many of the contracts we lost in 22 and 23, we were not only losing new customers, but we were also losing a lot of our current customers. So the first thing that we needed to do is just to go, okay, let's just make sure that those customers that we have want to stay with us. As renewals come out, let's just make sure that we win those, because that wasn't happening, right? So before I can believe that I can go and take business away from competition, I have to stop competition from taking away a business from us. So that's what I say, sometimes the best attack is a good defense, right? So we've been on this, and I think if you look at improvement of customer satisfaction and an improvement on the retention rates and the renewal rates, I think that speaks to that effort. There are areas where we haven't won what we need to win yet in terms of percentages. And I shared on the release two areas that are of high importance for us. In the public sector, we need to win more medium-sized deals, right? We've been good at going after the big and hairy, but we haven't been good at after being successful in the sort of more medium-sized, particularly a lot of that in the local government area, but not reduced to this stuff like that in different NHS trusts. There's stuff in some government departments. So medium size is a priority. And then on call centers, as we have moved the value proposition, as now we've got more offshore, we've got a more high-tech base, we now have created a pipeline, and now we are attacking the pipeline to also start looking for new businesses to win. So this would be two key areas. What have we changed? I would have to sort of say, what haven't we changed? We've got less people in the go-to-market, and the reason is we need less. They are way more targeted and way more focused on what they need to do. We've changed the compensation plan. We've changed the delegation and authority plan. We changed the value proposition. We've taken cost out, so our better cost structure also finds its way into a better pricing into the deal. Our value proposition is different. We're doing more offshoring, where the deal allows us to do offshoring, and we're doing more automation, and we're starting to now also look at business processes, business model changes, right? Where we might not just charge you for full-time equivalents and people that we got, but we will charge you for an outcome, like the case I talked about, customer registration for uses of tunnels for TfL. So we are playing with absolute every single key on the piano, and that's a key priority for us going forward.
Okay, we've got a couple more questions digging a bit deeper into the pipeline. So how does the 11 billion of opportunities compare to levels in previous years? And if you split that between renewals of existing contracts versus new opportunities, what is that? What would be a good renewal rate or win rate?
Yeah, so it's the pipeline as it is about 1 billion higher than it was at this time last year, and that's even before you take into consideration that there was a big biggie in there, which was the armed forces deal. So in terms of visibility, we have more visibility now than we had a year ago. From a quality of the pipeline is also better than we had a year ago. Now, it's very difficult to give you an average, right? Because there's a lot that hides behind an average. We have very different businesses. I expect to win 2 and 3 or more in what we do in the naval training space, because we do a very good job there. And for me, every loss is an absolute loss. And I expect, a very, very, very strong win rate. I expect a very high win rate in pensions, because we're winning a lot, and particularly when it's defined benefits, we have a really good value proposition, and we win often, and we win a lot. And now with the digital value proposition, we're winning more. So there, I don't want to see hardly any losses. I know there's some spaces like going after somebody else's call center. I have to have more modest ambitions initially, right? So, but I would be looking at winning initially 1 in 3, right? So I have to give you a caveat answer to win rates, because we're in different leadership position or challenger position in different businesses. But we're looking at all of those as when we say mass win deals, and we have listed and identified and resourced the mass win deals, we take all of these things into consideration, why something would make it into a mass win deal.
Thank you. Got a question here, again, looking on detail in the finances. So impairments have for several years been quite unpredictable, and there have been a few nasty surprises in the accounts, making the P&L tricky to understand. Do you expect unexpected impairments to emerge in 2025, or indeed expected impairments that you might anticipate but that we don't know about yet?
Good question about impairments. Let's see. Last year we had a segment that was Capita Experience. It had the contact centers in it. It also had pensions. Everything was together. It was hard to see as we split things out to have full transparency, we better understand what we've got in each of them. If you look at this year also, there has been a strong revenue reduction in the contact center business. That is a lower base for our cash flow projections, where you've got lower EBITDA, lower cash flow, supporting the same goodwill that has been split and allocated this year to wherever it belonged to contact center pensions or regulated. That left us with around 150 million pounds of goodwill in the contact centers. And having looked at that lower revenue, lower cash projections, etc., it was not sustainable. We had to impair it. Obviously, if I take a goodwill impairment, I want to take it to a prudent position that does not leave me exposed in the near term. So we've looked at it hard, we've taken a balanced position, prudent position that the auditors were happy with. And we've written off half of the goodwill we had in the contact centers. I can never say never, but for now, based on the business case and the business plan and the projections we've got on the table, we've taken a prudent approach that I hope is not going to take me double dipping in June, to be completely honest.
Thank you. Here's a bit more about the culture. You said that elsewhere, that Capita is not a technology company, yet technology is one of the main tools used to change Capita. How do you drive change at Capita culturally from being BPS, not BPO, and how do you cascade that message down from the C-suite to the employee base?
Excellent question, and one that I wrestle with every day. Absolutely every day. We're not a tech company. We don't build microchips. We're not building language models. We're not building cloud partitions. We are, thankfully, as I said earlier, there's others that do that. But make no mistake, I want to be the BPS company that doubles down on technology and uses technology with a passion to get those customer outcomes better and faster than anyone, right? And I believe, and you know, that shouldn't be sort of just be saying this, but I have to say this. I believe my background and my understanding and my ability to relate and engage with my former peers in my former industry, I think it's a differentiator, because I speak their language. I'm one of them who believes that taking their staff into here is critical. And I am messaging that internally every day to my colleagues. And it's a battle, because they always are doing things, sometimes keep emerging and re-emerging. And, you know, yeah, there's some people who, the first thing they think, okay, what is the business architecture? Is it 100 or 200 or 300 people? No. The answer, business architecture, is a business architecture question. It's not about how many people you can stack on a shelf, right? So we are having to change people. I've changed the operating model. I've created a product house, so that we build replicable products and solutions, that everything is productized. And eventually this year we will have a menu of these are the things that Capita sells. These are the capabilities built on tech that Capita sells, that will be augmented by people, rather than the old Capita, which is, this is how I can do labor arbitrage, right? So I'm bringing in new people, and then I'm educating the existing teams. We're doing a significant amount of training. We're investing a lot in data academies, Gen AI academies. We've also extensively working with Multiverse into a data and AI apprenticeship that is being taken up by colleagues. So this is every day. We're also sharing a lot of the use cases. People can see them. We're also sharing success stories from colleagues who all of a sudden feel a lot happier because they're working with AI and they're more productive. So yeah, instead of hearing it from Pablo or myself, they're hearing it from other agents, and we record them, they do the interviews. So we are playing on every single front, but make no mistake, it will take time. And it's something that we have to win one little battle at a time, one project at a time. You know, the TFO area, I don't have to worry about it, right? The CTO there is all for it. He's leading the pack, Adam, and he's already at our track age. Other accounts, it's just going to take a little bit more time. But this is not optional, right? We're giving people the chance to get on with the program. Most people have gone from denial to curiosity to now starting to engage. And I'm expecting that will be a lot more conversion in 2025. And it might be some that decide this is not a place for them because they like to sort of say hundreds of people, and that's perfectly okay. But I believe there is a great future in BPS for technology augmented humans in the loop, dealing with complex outcomes for governments and large enterprises, and that's what we're going to be.
Thank you. We sort of come to the end of our time allotted, but I think there's one question which is worth answering here, because I think it's relevant at the moment. And that's, given the Labour Party's announced plans for civil service reform, particularly the focus on digitalisation and efficiency, what specific areas of those reforms do you see as the greatest opportunities for Capita? And what steps are you taking to position the company to win contracts in those areas?
Excellent question. Absolutely brilliant, and very much at the core of what we're doing. So if you look at what the Labour government was talking about before they came to power, and what they've been talking about, government promises and priorities, there is a good overlap in some of the areas where we have traditionally been strong. So if I look at what we do in terms of employability services, that's definitely an area where we believe our work with the government currently, but the new things we're putting on the table, it's going to be very relevant. We are already putting on the table with one of our large customers, the Department of Works and Pensions, concepts on the table to do Gen AI based processing of some of the backlog. We're also bringing in healthcare, right? So everything that has to do with primary care capabilities. Again, we're looking at extensions of the current capabilities and the current service that we provide to them with many of the things. What has fundamentally changed is since Sir Keir Starmer talked about and released the UK AI playbook, we've gone from AI being banned and so like, oh, this is really difficult and very risky, and procurement and knowing how to go for it. Now the blueprint says, do pilots, do trials, find what works, where does it work, and then once you're there, go and scale it, right? That was, I don't want to say heresy because I'll probably get quoted, but that was nowhere the reality 12 months ago. So I believe that also with the change of the arrival of the new UK Procurement Act, right? Combined with our presence in some of these areas, right? I didn't mention defense, but obviously defense and national preparedness is the other space where we're good, right? Employability service, benefits, the work that we're doing in healthcare, and the final one, education, right? How do we get AI into schools for teachers, for students, for some of the processes that we're managing today, like standards testing, disability allowances. Those are the key areas that we're in, and unfortunately, because government moves slower, it will not be material in 2025. But this is one of the areas that I think strategically is a really important tectonic shift for Capita at the right time.
Brilliant. Adolfo and Pablo, thank you so much for your time this afternoon. I know we've run over a little bit. Just before we conclude this webinar, I wondered if you could perhaps just say a couple of concluding remarks, and then after those remarks, could I just ask attendees if they wouldn't mind when they exit completing the feedback forms. It really is appreciated by management. And my final remark would be to say, look, apologies, I know there have been a lot of questions that have come in today. I know we haven't had time to answer them all, so I do apologize about that. We've just run out of time. So Adolfo, would you like to just make a couple of concluding remarks?
Sure. So obviously enough, right, there's additional questions, just get them over to our IR team, right, and we'll address them, right, so we don't want questions unanswered. As a concluding remark, you know, I coined this phase, it was more intuitional than anything a year ago, which we needed to get smaller, to get stronger, to get fitter, to grow. And I think we're into that. I think we're now showing that we're getting stronger in certain areas, getting fitter in certain areas. What I didn't know at the time, it was important to get clearer about the strategic intent, which I think we're doing, and I think clearer from a financials perspective. So I would say, you know, a lot of hard work in 24. I think we got to the bottom of what is it that we're dealing with. We got a plan, we're executing. There's still a lot of hard toil and labor ahead in 2025. But I think it's just now way clearer into what we're doing in each segment, what is the priorities, the team So yeah, just thanks for the support so far, and looking forward to give everybody the Capita that everybody wants to have.